Amerizuela is here. The Fed totally abandons their inflation mandate in favor of emerging market style fiscal dominance. If you missed yesterday's FOMC bombshell, the Fed just cut rates by 25 basis points with core CPI at 3.1% and all inflation metrics closer to 3 than to 2%, which is their target. Is this the end of independent monetary policy? Emerging market style fiscal dominance is here and it could get wild. Meanwhile, markets are melting up. Gold, equities, and home prices are all at or near all-time highs. But here's the dark side. The K-shaped economy is about to get worse and the middle class is about to get crushed. So here we can see, of course, assets just ripping, whether it's homes, equities, or gold. Remember that what the gold price is telling you is here is the dollar denominated in gold terms. So it's not such a pretty picture once you realize what that is actually indicating. Here we'll go through very, very briefly kind of the main points from the Fed meeting and the press conference yesterday. We can see that the curve is starting to steepen again. The pink line represents the 30-year minus the 2-year yield. That bull flattener we've been seeing, economic uncertainty, kind of lower growth, those sorts of concerns. The curve is starting to steepen again. We can see the 30-year yield is starting to move higher, as is the 10-year yield. And of course, the Fed cut 25 basis points. We can see that in white, representing the federal funds rate. So very quickly, we're going to go through some of the key points from the FOMC notes. And of course, we have data for everything. We will take a look at the implications. This is a major turning point for the U.S. economy and for the impact on everyday people. So we'll go through some of these points that he made that appeared important. So he described the 25 basis point cut as a risk management move to preemptively address downside risks in employment. We'll take a look at what the data actually says with the labor market. He noted a curious balance with both demand and supply slowing down in the labor market, leading to fewer or lower non-farm payrolls prints per month. Something, if you've been watching the channel, we've been talking about for months now. Unemployment is low, but has risen to 4.3%. He noted wage growth is moderating, but still above inflation, not actual inflation, but their measure of inflation. He noted sticky pressure from goods and tariff impacts. We'll take a look at what the data actually says. Again, very, very little goods inflation is actually being seen, and that they will continue to monitor the kind of tariff side. He mentioned that near-term inflation expectations have risen, but long-term inflation expectations remain anchored at around 2%. And of course, a stronger growth, they actually revised up in their SEP. They revised up their growth forecasts and driven by consumer spending, which he noted was quite strong. We'll take a look at that data, and business investment. He noted that a 50 basis point cut was not seriously considered, although we can see Stephen Myron down here advocated for a 50 basis point cut. And they favor a cautious approach. Future policy is data dependent, not preset. All the typical things that we've heard. He also addressed immigration policy and the role that is having on wage growth and the labor supply, but stressed that the Fed is independent from politics, said that no preset path there is no preset path for rate cuts, further cuts, but the median dot, as we're looking at here, suggests 2 more cuts, 3 cuts in total, including this meeting that we just got. But they are ready to cut even more if the labor market weakens. We're probably likely to see a steepening of the yield curve. I think that 2 weeks of flattening is probably over or very close to over. I will link the transcript in the description so you can read that. Here's what really matters. They just cut 25 basis points with inflation closer to 3%. In fact, core inflation is at 3%, than to their 2% target. Now, of course, he also mentioned inflation expectations remaining anchored. But again, if you look at the survey of actual Americans, their inflation expectations for the next 1 year are about double the headline CPI or headline PCE figure. So this well-anchored inflation expectations, it's not backed up by the data. Average Americans are expecting higher inflation and probably not necessarily wrong in those expectations. It should be noted on the tariff point that goods inflation only accounts for 27 basis points of that headline CPI, which is 270 basis points, only 27 basis points of that is coming from goods. The vast majority of inflation right now is coming from services. Again, that is that stickier inflation. However, here we're looking at the price of oil relative to the 10-year break-even rate. This is derived from the tips relative to the 10-year Treasury yield. We can see since August of last year, this has been trending up, the 10-year break-even rate, despite oil prices trending down. This is something we've been noting since April or May, by the way. And if you look at oil, so I've been saying that I think oil and commodities writ large could probably do quite well over the next year or two. Well, this just adds to my conviction. So here you can see that the net long positions for oil are at a record low. So we are very likely to see a pop in commodities, a pop in oil. Well, remember, the only thing keeping the headline CPI or headline PCE below 3% is energy. So you get a pop in commodities due to a weaker dollar, higher nominal growth around the world, maybe a reacceleration largely driven by a weaker dollar. You get that sort of pop in commodities. Well, this 2.6, 2.7, that goes to 3% very quickly. The only thing keeping it closer to 2.5 is energy. Again, core is running at 3.1%, and they not only just cut by 25 bips, they're indicating 2 more cuts this year. So here we're looking at growth, real GDP, and inflation, of course. If you look on a quarterly basis with nominal growth, it is running at 6%. So while all the CNBC experts were calling for a recession here in April, and we were saying no, nominal growth is going to reaccelerate. Well, not only is that backed up by the data, what happened, but the Fed is now coming around to this view of higher growth. Again, not saying the K-shaped economy is not real, not saying people aren't hurting, but in aggregate, with the data that we have for the total overall U.S. economy, we're likely to see a reacceleration. Growth will be okay. There's no imminent recession risk like some might be saying, especially not with the 7% procyclical deficit. Here's one of the things that is driving that stronger growth. We can see retail sales, 5% nominal, 2.1% real. This came out a couple days ago, and it came in way hotter than expected. So retail sales, a huge component of the U.S. economy, is driven by consumer spending. That consumer spending, by the way, which is almost entirely, well, half of consumer spending is driven by the top 10%. So it's very bifurcated. The lower half of the country is really hurting, but the wealthy have more wealth than ever, as we will see in a couple slides, and they can afford to continue to spend, especially if assets like the equity market continue to rip higher. Here's non-farm payrolls, a couple points. One, you can get a single month of weak non-farm payrolls prints outside of a recession. So that's point one to consider here. Point two is that also, once you factor in, again, that normalization of not only the kind of monetary easing during 2020, 2021, and then the subsequent tightening, not only that starting to trickle through. Remember, macroeconomic forces take years and years to play through. So not only normalization from that, but normalization from the last administration importing 10, 20 million in terms of the labor supply. Well, this administration is doing the exact opposite. You have net migration at 0 last I checked. So you're going to see normalization. Not only that, but even if you took those 2 degrees of normalization out, you can still get weak non-farm payrolls prints outside of a recession. So I think looking at the averages, the direction is clear. But again, this is also normalization from a really, really hot economy during that initial wave of kind of fiscal spending. Of course, you're going to have slowing from that. It'll take a lot to really plunge the U.S. into recession. One of the things that kind of raised our recession probability was a couple days ago, we had initial jobless claims. This came in, this broke out. This broke to a new, I think, 4-year high. Yeah, about 4-year high. And this was something where I said, okay, the recession probability went from, say, 30% to maybe 40%. Well, it turned out that this was driven by fraud, not fraud in the data, but people filing fraudulent unemployment claims in Texas. So thank you to Zero Hedge for this chart. We can see that once that fraud got corrected, the initial claims reading is still is fine. And if we look going back to the 1970s, again, initial claims, even the averages are still very, very low. So yeah, you might see a slight tick up. I mean, the Fed said they expect unemployment to tick up slightly before moderating. I think 4.5 and then falling back to 4.2 was their kind of direction. You can see, further weakness in the labor market without a recession. We are at very, very low levels of initial claims and headline unemployment. This was another thing people looked to the labor market and said, see, it's falling apart. It's totally, we're going into a recession. Well, again, going back to 2000, for 18 years, you had unemployment above job openings. In fact, by 6 million, 2 million, 8.4 million, this is probably 11 million if I measure it there, that was the norm. So yes, you did see a huge degree of volatility when it comes to job openings, unemployment, inflation. Everything just got way out of whack during that 2020 into, say, 2022 period of time. Now, things will take a while to trickle through. And of course, then you add into it all the immigration policy from the last administration. That just only added to kind of the dislocations that we saw in not only the labor market, but elsewhere. So here we can see assets. We're looking at the price of gold, which remember, this is gold denominated in dollars. Here is the dollar denominated in gold. It's a pretty scary sight. And of course, the same picture is true with equities. The same picture is true with the average home price. Here's the Case-Shiller home price index, just screaming higher, setting new all-time highs. Now, of course, certain markets are seeing declines, but in general, again, in aggregate, overall for the U.S. economy, average home prices are going up. Well, that is to be expected when the denominator, the dollar, is weakening. If the dollar buys you less and less and less at an accelerating pace, we know that official core CPI is running at 3.1% and is likely to head higher. Then of course, yes, assets will be screaming higher. But again, in real terms, once you address for the denominator losing value and therefore requiring more of them to buy the same one share of the S&P 500, the same ounce of gold, the same single family home, once you adjust for the failure of the denominator, which is the dollar, we can see that, for example, S&P priced in gold has gone nowhere over the past 4 or 5 years. So it's important really for people to understand what is actually being indicated by the gold price going vertical for the past 2.5 years. The gold market sees what is coming, and it is a significant loss of purchasing power of the dollar. And again, remember, markets are forward-looking. This should be terrifying the Fed, but again, they are trapped because again, the interest rate on the debt, 3.3%. Well, there's nowhere on the curve where you can issue at lower than 3.3, meaning they have to cut another 50 basis points to get those low rates or short-term rates, bill yields. They have to get those lower and then issue even more of the debt at the short end. Again, very emerging market-like, very inflationary, very stimulatory, and indicating an erosion of the Fed independence. Because when you are rolling your debt every 1 month, 3 months, 6 months, you can't hike rates, right? If inflation does go to 4% over the next 6 months, the Fed is trapped. They can't really raise rates because then they'll blow out the interest expense, therefore blow out the deficit, and quite likely send bond yields even higher because, again, we're starting from a 7% pro-cyclical deficit, as we can see here. The fiscal deficit, or the difference between government spending and government revenue, 7% of GDP. This is not seen except for a major recession or something like a world war. And of course, this has worsened by 8 percentage points as a share of GDP over the past 25 years. We went from a 2% surplus, actually close to a 3% surplus, to now a 7% deficit. And that is despite having an unemployment rate that is actually lower. Now, of course, this is the K-shaped economy. So here, of course, all the wealthy, they own assets. That is why they are so wealthy. We know the top 10% of U.S. income earners own 93% of equities on a household basis. So the lower 60, 70% of the country does not own assets, especially if you're younger. You don't even have a home to protect you. Remember, homes are just levered exposure to currency debasement. But you don't have assets to protect you from inflation. This is why, by the way, if you take total wages as a share of GDP, this tells you GDP, or the US economy, has been growing faster than wages. This is total wages, not per capita, total wages. It's even worse if you look at it per capita. And of course, GDP has been growing faster than those wages. Well, is the opposite when you look at the net worth of the top 1%. That has grown not just at the same rate as GDP, which would already be outperforming the average American. It is growing faster than GDP. That is why the white line is going up and to the right. And of course, this is driven by assets. Here we're looking at the S&P 500 relative to GDP. This S&P 500 financial assets have been outperforming the overall economy. And again, who owns all the assets? It's the wealthiest of the wealthy. And of course, here is the average hourly wage, or the S&P 500 in average hourly wage terms. This shows you the number of hours of work at the average job for the average American to buy one share of the S&P 500. It has gone from 39 here back in the mid 1990s to 180. What this is indicating, financial assets are grossly outperforming the average hourly wage. This is the K-shaped economy in this slide. And of course, look at what assets are doing. They are screaming higher because we are entering this fiscal dominance regime, this emerging market-like approach to central banking, this abandoning of the inflation target. I mean, they basically all but said that inflation's going to be 3, maybe even 4%, but is what it is. Sorry, average American. By the way, I will point out that when it comes to how the average American experiences inflation, it is not via a year-over-year sort of thing. It is a cumulative loss of purchasing power. So here is that CPI index. This shows prices. And what you can see is they just go up and up and up. And if they're going up at an accelerating rate, this compounds. So for the average American, this is a compounding issue. 3% might not sound a lot worse than 2%, but remember, it is compounding. So 3% is significantly worse than 2%, and 4% is significantly worse than 3%. So a higher inflationary environment, that is what gold is pricing in. It is pricing in a decrease in the purchasing power of the dollar. It is pricing in a fiscal dominance sort of approach to U.S. central banking and monetary policy, where again, the purpose of the Fed, much like it was during World War II, was to finance deficits, to finance the fiscal deficit, to finance and keep interest expense low. That is what fiscal dominance indicates, and it is an abandoning of the kind of old way that we looked at the Fed, which was their goal is to keep inflation, relatively low at 1.5%, 2% since 2008. They were able to do that. They were able to keep unemployment, generally outside of the initial wave of a recession, keep that relatively low. Well, in fiscal dominance, your only goal becomes to finance the fiscal deficit of the government, which again, 7% of GDP. What that means is every year, 7% of the $30 trillion of GDP, 7% must get issued in new debt and bought by someone. Now, who is buying the debt? Well, if we look here, if you total up all of the corporate profits in a given year and all of the personal savings, the deficit every single year would eat up about half of annual corporate profits and personal savings. So that is the degree to which this deficit is just exploding and crowding out productive investment, crowding out a real productive private sort of investment. 50%, basically half of every single dollar of corporate profits and personal savings would have to go to buying US government debt every single year. So the fiscal deficit, remember, a public sector surplus is a public sector deficit is a private sector surplus. One of the things the MMT crowd does get correct. And this has been, of course, we see the bifurcation even within the equity market, even within corporations. The vast majority of the profits and the earnings growth is coming from like 5 companies. Well, so the K-shaped economy is not just true for the average American relative to, say, a high income earner. The K-shaped economy is also true within corporations, within the equity market itself. I mean, just look at the IWM or the small and medium caps versus the Mag 7. We see the same K-shaped economy there as well. So here's how assets have performed over the past 2 days. We did get an initial sell-off in equities, but as we can see, they are screaming higher today. Gold and Bitcoin, gold is taking a bit of a breather, but is basically doubled over the past 2 years, is on an incredible run recently. So gold is taking a bit of a breather. Probably some amount of this was probably already priced in. So buy the rumor, sell the news probably with gold. Bitcoin is moving higher, and yields across the curve, we are seeing that steepening of the yield curve, which is likely to continue. Again, that is indicative of that kind of higher growth, higher fiscal deficit, concern about the fiscal side. You get that steepening of the yield curve with higher inflation, higher growth, running it hot, as they told us they were going to do many months ago. I mean, this is the thing. We started putting out videos. Look, inflation is headed higher like 3, 4, 5 months ago, because they were making it clear. Okay, we tried Doge, but yeah, we totally given up. David Sachs, Elon Musk, Scott Bessent, they all said, yeah, we're going to run it hot. Well, running it hot, if you own assets, you will do extraordinarily well. If you own, whether it's equities, real estate, or scarce assets like gold, you will do well. Equities even should in nominal US dollar terms go up. But again, remember, you have to adjust for the failure of the currency, the failure of the denominator. Start pricing the S&P 500 in euros or in Swiss francs or in gold, because that is really the story. And look, that was the story for the last period of time that the U.S. had populism and all of the cultural issues with assassinations and all that sort of stuff. We did a whole video on that. The last time that the US was in that sort of environment, gold ripped higher. Equities basically went sideways from 65 to 1980. They basically went sideways in dollar terms, but in gold terms, they were down like 85%. There are a number of indicators that inflation is likely to be sticky. I mean, I think that is already proven at this point. Inflation is going to be sticky. It is structural. We are running 7% of GDP deficits, which account for 50%, almost 50% of total corporate profits and gross private savings. 50% every year must go to buying U.S. government debt. Well, we know that's not possible. This part of that crowding out sort of phenomenon that we are seeing. But I think this was a really notable pivot, a really notable press conference. Whether or not day to day, a court case with Lisa Cook, I think people need to zoom out and look, maybe Lisa Cook wins her court case. Maybe, this or that on a day-to-day, week-to-week basis. But if you zoom out, Trump will have a majority by the end of his term. We know that the overall direction of travel is fiscal dominance. This is what the gold price is pricing in and has been pricing in, by the way, going back to the last administration. This is not a political thing. The last administration was running utterly insane deficits as well, and doing some of the wonky business with activist treasury issuance, shifting all the issuance into short-term treasury bills. They were eroding the Fed independence long before this current president was sworn in. So this crosses over a lot of those sort of partisan lines. I would encourage people to just look at the data, look at it objectively. I understand tensions are really high right now. Try to just be objective, and look at the overall direction of travel. Zoom out, and do your best to protect yourself. There's not a licensed financial advisor. I can't give financial advice, but negative real rates are coming. that will be stimulatory, that will cause weakness in the dollar, both in purchasing power terms for the average American, but also relative to other currencies. We're going to see higher inflation. We're going to see assets move higher due to that weaker underlying denominator, which is the dollar. And the K-shaped economy is likely to get worse. A lot of people think, oh, it can't possibly get worse from here. Well, yes, it can, unfortunately. And how that ends up resolving, I'm not sure. But, anyways, hopefully that was helpful. This is clearly a turning point, very, very major, notable press conference and Fed meeting. It is likely they're going to continue to cut with inflation at 3% and assets screaming higher, whether it's home prices, equities, or gold. This is clearly the direction things are headed. And so, consult your licensed financial advisor, find a way to try to protect yourself. And I will catch you on the next one.